So good morning, everyone. Thank you for joining us today. My name is Paola Garibay, and I am the Project Manager of Economic Development here at the Berwyn Development Corporation. Today, we have Libby Popovic from Popovic Law. She will be presenting. I will let her introduce herself a little bit later here. And then we do have Marcos on our staff as well, who will be monitoring the waiting room and the chat if anyone has any questions. If you do have questions throughout the presentation, please feel free to drop them in the chat. Libby is comfortable with taking questions throughout the presentation. So if you don't want to wait until the end, maybe you'll forget, she will take questions throughout the chat. So today we will be learning about capital investment and expanding your business. Before we get started, I do want to go through some quick housekeeping items as far as the Cook County Small Business Source. Some of you may be familiar with the Cook County Small Business Source. This is an organization that is made up of business support organizations, the Berwyn Development Corporation being one of them, and others across Cook County, which are all a network of resources that are intending to support small businesses. So I'm going to tell you a little bit about the Cook County Small Business Source and some information on the Source Growth Grant if you applied for that. So an overview of services, the Cook County Small Business Source provides ongoing business advising to small businesses. So that could be like today, we're having a group advising session by webinar. But we do also have talent across the network who is ready to sit down with you and have a one-on-one conversation on any subject that you may want more information on for your business, be it marketing, access to capital, investment, real estate. If we don't have the information and the talent within our staff, we do have a network of referral partners. We have over 30 referral partners. So if we don't have the information, we don't have the best resources for you, we do pass you along to the best indicated person. And then we do also collaborate with Cook County. So leaders of the Economic Development Board with the Cook County Small Business Source and bringing together all of the partners across Cook County to network and talk about how we can improve the process to get more of these dollars, much needed resources, business advising to small businesses. A little bit more about the Cook County Small Business Source. So through our efforts, this program started in 2019, trying to help businesses recover from the impact of the pandemic. I'm sure you have all been impacted by it one way or another. So this again is intended to help businesses recover from the pandemic, but we have seen a need. Of course, we're still feeling the effects of it. So we want to continue this program and continue to offer small business resources. So that is our goal here today. Through this program, we've been able to reach over 10,000 small businesses in Cook County, and $17 million in grants have been administered to businesses with 20 employees or less as of today. And we do still have that Source Growth Grant pending and hopefully a couple others later this year. We have done a total of 3,800 business advising sessions, whether it be one-on-one or group advising sessions. That is how many businesses we have reached. And some cool stats on that is that we do really support, diversely owned businesses, minorities. So 63% of the businesses have been owned by people of color, 53% of those by women, and 78% of those micro businesses, again, being businesses that have 10 or less employees. As I mentioned, the Berwyn Development Corporation is one of the proud business support organizations with the Cook County Small Business Source. On the screen here, you'll see some of our other partners through the network. You may recognize some of these logos. These are all organizations that are part of the Cook County Small Business Source, delivering similar services to the BDC in business advising, helping you apply for grants and share resources. So if you applied for the Source Growth program, you may remember this was back in October. It was a pretty tight deadline to apply by the end of the month, and you should have expected to hear on your status of award early January. We do have some updates from Cook County. We're now looking at a timeline of mid-February to hear back on whether or not you will be receiving the grant. One thing you can do to get ahead of the game is make sure that your business is in good standing. So if you do have an LLC or a corporation, you need to have a certificate of good standing with the state of Illinois. And on this slide, you'll see how you can go and do that. We'll share a link as well. You'll all have this slide deck and the link to go verify that your business is in good standing after this presentation. So you can go ahead and take a look at that. If you do not have a certificate of good standing with your LLC or corporation, it will make you ineligible to receive those grant dollars. And then lastly, I just want to remind everyone that this webinar is being recorded, so please practice tech etiquette. So keep yourself muted if you don't have a question. Keep your camera off if you don't want to be on the background. If you lose connection, please just click the link again and come back into the meeting. One of us will let you in. If you do have any other questions, you can drop them in the chat. We'll be monitoring that as well. And I will now pass it over to Libby to introduce herself and lead our presentation here.
Okay. I think we're ready.
All right.
Okay, great. Well, welcome. Thank you. Thank you, Paula. My name is Libby Popovic, and I'll be spending the next 45 minutes talking to you about capital investments and business expansion. So just a little bit of background for me, from me to you, so that way you guys can know what I've been through, and that way you can ask me any questions that you have as we go through this. So I am the managing partner of Popovic Law. Prior to that, I was the managing equity partner at Caputo and Popovic, and then I branched off into my own law firm. And prior to that, I worked for Cook County State's Attorney's Office. So over the last 23 years, I've had both public sector and private sector experience. And I've got to say, opening up my own firm over the last 12 years and dealing with all the ins and outs of business, organization, operations, capital investments, real estate, and so forth, has probably been one of the hardest, but it's also been one of the most rewarding. So I completely understand where you are coming from. I've probably been there and done that. So during this presentation, I do encourage you to ask any questions that you might have as we go through this. If you have a question, someone next to you probably has a question as well. My background now, what I focus on primarily is residential real estate closings, commercial real estate closings, estate planning, including wills, trusts, power of attorney, both financial power of attorney and medical, and then also business planning. And on the business planning end, it's setting up an LLC, operating agreements, letters of incorporation, and so forth. So this dovetails perfectly with kind of what we do. We've got an office here in Berwyn, Tinley Park, and Chicago. So that being said, I'll kind of get on with the rest of the presentation. So what is capital investment? Let me move this over. All right, what is capital investment? Capital investment is often referred to as capital budgeting as well. And it's essentially any type of investment that you're going to be doing to your business above and beyond your normal operating expenses. So it's a process that includes planning, setting goals, priorities, arranging financing, and using certain criteria for selecting long-term assets. Now, how deeply you go into this really depends on the nature of your business, whether it's a service industry or it's an industry that creates widgets, for example. So capital investment is the broad term for your next step in your investment. And my understanding is you all have your businesses set up and you might be thinking about taking it to the next level, or you're already there and you need to take it to the next level. So hopefully this will be able to educate you on all the different options that are out there. It gives you the broad view of everything that you might need to know or think about as you're moving into this. So capital investment provides funds for the long-term growth. And it's a fund for strategies that you might have for long-term growth. But I do always start this presentation by reminding people this is not to sustain your immediate operating costs. So we keep those separate. You have your operating costs and you can review them monthly. Hopefully you review them monthly, certainly quarterly on your profit and loss statements and your balance sheets. So you know what's coming in, you know what's coming out. That's kind of the short answer of what you have. But capital investments is for your long term. You're investing in a big buy. You're investing in real estate. You're investing in another real estate. You're investing in funds for purchasing or for human capital, which is bringing employees in. So capital investments does not include operating costs. It includes your long-term growth. So I want to frame it in that way so you can start thinking about not what's happening right this second, but what you want to happen and what can happen in your business, both organically, it's happening, the market's changing, and that which is planned. So what makes a good capital investment? Okay. A good capital investment is one that's going to earn back the original capital over its life. So you might invest $10,000, and if you make at least $10,000 back, you've broken even. If you've made more back, you are above, you're ahead of the game. So when you're thinking about investments, you want to be very, very clear on what exactly are you trying to accomplish. Is it to bring in more customers? Is it to drive more business in? Is it to expand, get more areas of expansion? Is it to be local and now you want to go regional? So what makes a good capital investment is the return that you're going to be getting from that investment. So a good capital investment is going to provide you a reasonable return on the original investment. Okay, what is reasonable? It depends on your industry and it depends on your comfort level too. If you're thinking you're going to double it, maybe you will, but you need to sit down and really look at the numbers and think about it. If you are increasing at 10%, that's a win. As long as you're in the black, as we say, so you're making the investment and getting something out of it and not in the red, meaning you've lost money on it. And we're going to talk about different options and different risks that you need to think about right now. So business owners really have to decide on the acceptability of the projects. That lays with you. If you started the business, maybe it's just you, maybe it's you and a partner. You have to decide on what are the projects and then compare the competing projects with others in your industry on the basis of the economic merits. So what does that mean? You need to know, where do you fit in this structure of competitiveness, and what are objects and what are projects that are out there that you need to naturally go after. If it's clients are an obvious one. Is it more employees that you need to bring in? So that starts with you sitting down and really kind of putting a list together of, I'm the business owner and what are the projects that I need to see happen in my industry? If I'm a restaurant, I need to maybe have more customers. I need to have more tables. I need to have more services. Okay. In my field, for example, as a law firm, we started off as a small law firm, and it was myself and a partner at the time. And then as the years went on, it expanded. So each of us had our own departments, and each department had its own needs for that. So also thinking about, are you expanding your business or are you scaling your business? So that's something we'll talk about throughout this presentation. Growth is one thing, so you're moving up. Lateral growth is another thing. And then scaling your business is bringing it to a point where you're really specifically targeting certain areas in your business, maybe keeping them at the same level, making sure that they're there, or allowing one area to stay the same so you can grow another area. So as business owners, you have to think about, what is your project and where do you want to go with it? So what are good capital? What are sources of investment? That's always the big question. So bottom line, where's the money going to come from? Obvious one is banks. So working with your local bank, your local credit union, a bank that maybe you bank at right now, is always a good starting place. Working with your chamber. For example, the BDC has an excellent resource, as Paula was saying, that offers different options and then can walk you through the different grants, which Paula is going to talk about a little bit later, and what's available to you. Then there's the obvious loans that you're going to go to as a business loan to your lenders. Then there's investors, private investors that might be looking to invest in your business, other financial institutions. And then there's, I mentioned it in there, angel investors and venture capitalists. So that's taking it to the next level where you have a group of investors, and an angel investor would be someone who just sees the growth in your company or your business, and they say, hey, I want to put all this money in here. I'm kind of going to be your financial angel because I see so much potential in this. And that could be an option as well, depending on the type of business you have and the vision that you have. So for an example, a restaurant might need a capital investment to update the kitchen with new equipment. And then that translates into the new equipment would improve the safety and enable the cooking staff to be more consistent with food preparation, for example, which in turn then makes the restaurant better. You get better reviews, better Google, and so forth. So like somebody is waiting. That's one area of capital investments. So what are investors looking at? And I use the term investors generically. Generally, in my experience and with clients that I work with, your investor is the bank that's going to lend you the money, or it might be another partner that's coming into the business. So investors are kind of used globally in this presentations. But what are they looking at? So one thing they're all going to be looking at is your business plan and your actual business model, as well as who are the leaders that are running your business. So who's actually involved? You may have started it, but maybe you have 3 or 4 people that are helping you with it. Are they actual, equity partners in it? Are they part of the staff? Are they part of the executive decision-making arena? So they're looking at who's running it, because at the end of the day, what investors are looking at is what's the risk. Is it a high risk, midline risk, or low risk? It's always basically divided into those 3 categories. High risk, kind of middle of the line, or really, moderate low risk. It's kind of like stocks and bonds. You can have high yielding stocks or kind of your run of the mill bonds. So that's what investors always want to know. So they will consider what kind of working capital do you need for the operations? Meaning, what does your business need right now, today, to continue to run? And what does it need for next month and the month after that? That's your working capital. So you need X amount. For example, you need $10,000 to operate everything for the month. So investors are going to look at that first to see, what is your working capital up front? And then what is your long-term need? The long-term need is the capital investment part. That's the part that they're going to be looking for in the future to see what it is that you can grow and expand to. And what's the risk? That's the risk area that they operate in. So investment capital is less often used for funding operating capital. So like we talked about earlier, your run of the day, every day money that's coming in and out, that's not what the investors want to see. They want to see, what do you need? And then what are you going to be applying for future? Okay. Any questions so far? I want to ask. Any questions, Marcos? Because feel free to jump in at any time as I'm going through all this.
No questions so far.
I just dropped a reminder in the chat for any latecomers too, that they can feel free to drop questions in the chat as well.
Yeah, absolutely. If anything I say doesn't make sense, or you have a question that follows with that, let me know. Let's see, this sharing is not going through.
You're still sharing. So you should just maybe click on your.
Sorry, I'm having a technical difficulty moving to the next screen. Just clicks through, see neither one of these is working.
Click into the PowerPoint.
There we go. All right. So to understand what kind of investment you might be receiving, so it's always important to put yourself in the shoes of your investor. You need the funds and you might have an idea of what you need it for. And by the time we're done with this presentation, hopefully you have a very clear idea of what you need it for, and you've kind of started the process of doing a budget and a project program. But you also have to understand what's the analysis that the investors are looking at. What's the bank going to be looking at? So they're going to estimate the quantity and the time of the cash flows. So what's coming in? What's the regular cash flow that's coming in? Is it on a regular basis? Is it on a bi-monthly basis? Is it a quarterly basis? It really depends on your type of business. And it also depends on the quantity of the business that you have. But that is something that an investor is going to be looking at up front. If, say, you're on commission and you don't get paid until the project is done, for example, then it might be on a quarterly basis. If it is invoices sent, invoices paid on a regular basis every week, then you have a regular steady cash flow. And that's something you do want to keep track of and have a really good idea of what's coming in. So that way you can pull it out and show it to the investors. Two, they're going to assess the risk of the investment. So like we talked about, they're literally going to look at it and say, hey, this is a high risk investment. If we invest 50,000 in this, we might get back 5, for example. Or this is a low risk. If we invest 50, we know that at some point, at least in the next year, it'll go up to 20%. So they're always assessing the risk of it. And that depends on your business, the nature of the business, and the industry in general. So you have to know what others in your industry are doing to make yourself competitive and to be able to explain the risk. And then 3, they're going to consider the impact of the project on your profits. So again, how much is going to be coming from it? If you invest, and I'm just throwing out numbers, if you invest 50,000, are you going, how is that going to translate to your bottom line profits at the end of the year, for example? Is it going to double, triple? Is it going to go up by 10%, 15%? So the analysis part is super important for all investors, whether you're going through a bank, a credit union, your municipality, that's always going to be a part of it. So the 3 things we are going to kind of focus on today, and this is across the board for all businesses. I'm in a service industry, for example, as a law firm. You might be selling products, you might be in the retail industry or wholesale, but these are 3 areas that if you have your business and it's up and running and you're ready to take it to the next level, these are things you want to consider. One is capital acquisition. So that goes right hand in hand with capital investment, which just means what's the next step? What are you going to acquire? Business, people, buildings, whatever it is. We're going to go through those slides next. 2, what is your business plan? So when you started this, hopefully when you started this, you had an actual business plan. You sat down and did a business plan. If you didn't, don't worry. A lot of people don't. You have an idea. So your idea is not your business plan. So even if you skipped that step and you said, okay, I'm going to open up a restaurant and I know I need this, this, and this, maybe you wrote it on a napkin, you ran out there, you talked to friends, you sent a couple of texts, you went on Facebook. A lot of people do that. That's the beginning of an idea. That is the beginning of an entrepreneurial endeavor. Now you're at the next level. So you need an actual business plan. And the business plan that you had last year might not be the same business plan that fits today because industries change, your capital changes, your clients might change, your needs may change. So coming from someone who went from full public sector to private sector to now moving into a very specialized niche, I understand that. You have to really have a good idea of where your business was and then plan on where it's going. And that needs to be in your plan. And we'll talk more about how you do your business plan because it's not just kind of thinking about it. And then the third one is expansion and branding. Okay, what is the brand of your company? Where are you taking it and where can you expand it? There's so many different places that you can go with that. So let's dive right into it. Capital acquisition. First of all, you need to know the types of funding that are available. So you got to know where the money is coming from. Okay. Everything with capital investments involves funding. You're either earning it yourself, you're bringing it in yourself, or you're going to others, investors, to ask for it. So there's 3 main types of funding. So just understanding that from the get-go, and don't get too tied up with the fancy names. Debt financing. What is debt financing? You get a loan. You're borrowing money. That's what debt financing is. You have a debt and you're financing it. So someone's going to give you a loan and you're going to use it for your capital investment. So it's less risky to some investors for this reason. If a company experiences financial hardships, and most do at some point, it doesn't matter what your industry is, I guess, unless you're like Amazon or Google maybe, but your run-of-the-mill everyday business is going to experience some financial hardship. The order of repayments for when there's a loan involved, it's payroll, then you pay your taxes, both property taxes if you own the building and income taxes, and then loans get paid out. And then the last thing is equity investors get paid out. So those are the people that invested in your company. So if you get a loan from a bank, that just means the bank's going to be paid out first. They also reserve, if it's a secured loan, you've secured it with a piece of property, for example. So that ensures that the bank is going to get paid back. So that's what debt financing is. You're looking for a loan for either a business loan or a personal loan some type of loan that's going to finance your next step. Second is equity financing. So that's really kind of taking it to the next level. But what you want to think about equity financing is you're bringing a partner in. Someone says, hey, you got a great idea. It's the next level of ownership. I want to be a part of it. Maybe you're thinking of franchising your business. You've got, for example, like a workout place, and it's a great idea. And then you know that you want to open one up here in Berwyn, and then you want to move out of Cook County. You want to go to Lake and DuPage, and then you want to go nationally. So you want to bring people in. So this is like buying stocks on the NASDAQ. And we're not going to get into that. I'm not a stockbroker, but just as an example, you're buying stocks. You're buying a share of Apple. You don't own all of Apple, but you own whatever shares you bought. So a company might have 1 million outstanding shares, and someone invests 500,000 for $1 per share. Now they have 50% of your business. Okay. And it doesn't have to be that complicated. Say you opened up your business, you put a lot of sweat equity into it. Now you've evaluated your business, and your business is worth, let's say 80,000. And someone comes in and says, I want to buy some of the shares and I'm going to invest 40,000, but I want to be a 40% owner. Okay. That's equity financing. So you're bringing people in to buy shares in your company with the understanding, with the financial understanding that it's going to grow and that they're going to be able to be compensated for being an equity owner. So business owners risk losing the company in a takeover if you give out too many of your shares. So just because you started the company, say you sell the majority of it, somebody else owns the majority, then you can also lose the rights to your company. Certain business owners think about that when I meet with clients and they're looking to they're looking for a plan down the road. Maybe they're retiring and they want to sell part of it off. That's a good way to go for that. And then investors are going to seek an owner who has some actual cash invested in the property. And that's just basically saying you have skin in the game. So you put something into it, you've invested in it, which makes others feel comfortable. Okay, well, if this person's invested in it, they believe in it, but they also put their money where their mouth is. They've opened up this business. We also will feel a little more comfortable investing in it. So that's just having skin in the game. And then the last one is lease financing. And it's exactly what it sounds like. You're leasing certain things. It could be a car, it could be equipment, it could be, a piece of machinery. So lease financing is used to obtain generally large equipment, machinery, or vehicles that are needed for the business operations. So as an example, at one point in our business, because I do a ton of driving back and forth for closings, it made sense to lease a vehicle through the company. And then it didn't make sense to lease the vehicle because you only get X amount of miles for that vehicle. And I was blowing through those miles left and right. So then it made sense to purchase that vehicle through the company. So, but you want to think about the lease financing to see, is that something that would work? So by leasing, the business owner is able to obtain things with less capital investment over time. So you're basically just paying it, either paying it off or just paying to use it. And then you can switch out the machinery, for example, or switch out your vehicle for updated models in a shorter period of time. Again, using the car example, you lease the car, it's through the company, you use it for company purposes, and 2 years into it, now you want to upgrade, you renew your lease, you lease a newer car, it allows you to get to more places. That's one example. So this type of leasing is offered generally by a bank or a financial institution, or simply the distributor. You go to Honda directly, you're going to lease the car. Now, if you are doing this, and this is a caveat, I don't have it in the slides, but if you're doing it through your company, then they will need to approve you through the company, but then you individually will be a personal guarantor for it. Okay. And we can talk about that more, but basically your company is leasing it, but you're guaranteeing that your company is going to pay for it. So knowing the types of business funding, very important, and which way you're going. Maybe you're using all three. You're going to get a loan, you're going to get partners to come in and buy equity into it. And then you might need to lease something for restaurant machinery or large equipment. Okay, so all three of those. So in your business plan, you're going to have 3 separate sections to talk about what's the risk on each of them, what's the return for each of them, what are you going to gain for each of them? And that's what your investors are going to look at. So the more that you can think of like the investor, the better it is, because at some point you're going to have to sit down and explain, here's the risk. This is why it's a really good investment in my company. So using your capital investment funds. So capital investment funds, like we said, those are funds for your long-term needs, not your short-term day in and day out. to pay payroll, to pay your taxes, to pay, any other operating expenses. This is long-term needs. So I get asked this by clients all the time, like, should you automatically run out and get a business loan? Okay. My philosophy is, no, you shouldn't. I tend to be a lot more conservative with that. I didn't get a business loan up front. We kind of had a you eat what you kill model. If you can't bring it in, you didn't earn it. You can't just run out and get a loan for the day-to-day stuff. Once you get to the position that you're starting to get some cash flow in, then maybe you can consider the business loan for the capital investment. So sometimes people confuse getting your upfront business loan with the capital investment, your long-term loan. They're not. They're two totally different things. One is to help your everyday, day-to-day stuff, and you have to really have a really good idea of where's it going to go. One is for your long-term growth and development. So capital investments are for long-term needs. The company requiring companies requiring the capital to maintain operations suggests that a company isn't sustainable, or that it's already a potential risk for financial hardship. Okay. So in basic terms is, if you are trying to get money for a capital investment to use it for your day-to-day stuff, something's not working out for your day-to-day stuff. And it doesn't matter if it's a service industry, you're servicing clients, or if it's a retail industry and you're selling widgets, for example. It means that you need money for right now. And that tends to not be what capital investments are for. It also shows that there's maybe a higher risk. So maybe you need an influx of cash flow right now for your first quarter because, things are slow. So just using the real estate market as an example, things are slower now than they used to be. So maybe January, February, March will be a little bit slower, but then it's going to pick up. So you need to really decide, do you need it right away? Is it an imminent need, or is it something you can wait for? So capital investments are designed to grow your business. So investors will consider how the business revenues are going to grow with those funds. So an example of the business could use a capital investment to open a second location, for example. Maybe this one here, you've got one open in Berwyn, it's doing great. You now want to open one up in Riverside or in Cicero or Oak Park. And that's a restaurant, for example. And then that's going to triple the overall revenues of the company, which then will then allow you to maybe do some equity financing. You say, hey, I've got 2 really great restaurants, they're running. Now I can get some investors to come in. So the purchase of a centralized warehouse, for example, in my example, could help you fulfill this goal a lot easier. So that's a great example of how a real capital investment would work. You're going to expand, you need a central location, something that's going to double your income and your profits down the road. So using capital investment funds, think about it carefully up front. There is no hard and fast rule that you absolutely have to get it right up front. Maybe you're waiting a year, maybe 2, or maybe you need it right up front. Capital investment funds are also used for the bigger items that you need for the growth. Like I said, for getting a warehouse, for example, signage is another big one. You might need a new trucking line. So say you're in the service industry, or not service, retail industry, you need to be able to deliver your products somewhere. So you might need a new truck for it, or vehicle service. Real property, you want to buy the building. You're tired of renting. And because I do a lot of real estate, it's a great time for investors right now. Like, all my investor clients are kind of coming out of the woodwork, because even though the rates are a little high, we always say you date the rate, but you marry the mortgage. So the rates will go down and you will be able to refinance, and you got to start somewhere. So maybe your rate's higher because you don't have a lot of equity, but you will build it. Why? Because you have your plan, you have your business plan, and then you're going to use your capital investment to grow your business in a very, streamlined manner. So real property is one way of growing it, being able to purchase a space and then expand on it. Also, you can use it for certain tax deductions as well. I'm not a tax accountant, but so we won't go into that too much. Mechanic bays or large computer hardware, depending on the kind of business you have, you're going to have some sort of software. And even if you started really lean and mean, I would say start your business lean and mean. Use what you can, like use your phone if you need to. At some point, you got to invest in the bigger structure, like computers, hardware, printers, scanners, whatever it is for your business that you need. So you can't just keep working out of your basement. New software is changing all the time. I know in my industry, we have certain software that, for the invoicing, for the accounting, for the bookkeeping, for the clients, confidentiality, all of that. So whatever your industry is, 100%, there's going to be some software out there. And maybe you tried maybe the cheaper route, and now you want to get something that's a little more robust. As your business grows, and this is why your business plan is going to change every year, you're going to review it. As your business grows, your needs are going to grow as well. So new software networks, for example, is a great example of a capital investment, because it's going to help you overall streamline your business, grow it, and become more profitable. And then simple things like updating signage, for example. Maybe you're at a place that you don't have signage, or you need more signage, or you need to get signage across town so that there's more visibility. So that's an example. So all of these could be funded with a capital investment, and it's not one or the other. It could be all of them. So working capital versus capital investment. I always kind of stop at this point so we can talk about each, because they're two different things, and it's easy to kind of conflate the two and mix them up. So investors don't want a business to use any capital investment for their working capital. And I know we talked about that. They don't want you to use it for your day-to-day stuff for just this month or just next month's stuff. Working capital is, the definition of it is, it's money used for operating expenses and your operations. So you really need to have that set aside. And if you don't have it set aside, my recommendation generally is wait until you get that set aside before you're looking into your capital investments. Get your house in order. Okay, your house is your working capital. Once your house is in order, then you can look to the other things. So what are investors going to look at? This is the nuts and bolts. So some of this you might know, some of this might be news to you, but they generally want 1 year's worth of working capital before even talking about capital investments. That's what banks, the traditional banks that are going to be looking at a business line of credit, that are going to be looking at if you're purchasing real property, real estate, for example, and you want to buy it through your business, they want to see, what is your capital for the year? Like, what have you done for the last year? Are you going to show a profit? Are you going to show a loss? Are you going to show something else? So when an investor is more likely to invest or allow the investment if there's real working capital that's being used, versus if you're just using the investment just to start up the business, because that's very risky. It's very unknown. Now, that's not to say that you can't borrow money to start the business. Many people do. You just have to be very cautious about it. I've worked with lots of different clients, and you really have to know exactly what your numbers are, bless you, if you're going to borrow money to start the business. So you gotta be up and running, because before you know it, you're using that capital investment for your day-to-day operations. And if it's going to take, say, a year and a half to really start turning a profit, that can get a little dicey because you're paying on that loan. So it's not free money. So be careful with that. Most investors want to see that the business owner has some ability to put some capital investment into his own company or her own company. That they just want to see that you've invested in your own. So when you opened up your company, maybe you loaned a certain amount to your business, or maybe you had what we call a capital contribution. So for example, when I started the firm, left public sector, went into private, we agreed, hey, we're going to put in X amount to start this firm. That was just coming from us. So investors like to see that because it shows that you're investing in yourself and in your company as well. And then working capital needs to be well managed, with business owners maintaining strict standards on that. And it depends on the type of business that you have. But this is the part where if you don't know how to do bookkeeping, you have to have someone help you or have someone be part of the bookkeeping. Keeping good books allows you to have monthly profit and loss statements. And then it allows you to have quarterly profit and loss statements and a balance sheet. So those are terms you need to get really familiar with, because every bank is going to look for them. And the quicker you can say, oh, you need my first quarter, no problem. You need last year's, here you go. So every month you need to not only know that because you need to know what's happening in your business, but you also have to provide it to the investor so that they can assess what's the risk. So this is one area that I can't emphasize enough. Regardless of what kind of business you have, this is one area that everybody should spend a little bit of time reviewing. How is your day in and day out stuff being managed? And the way it's being managed today might not be enough for how you want to manage it once it grows. Expenditures should match your budget expectations, and the company revenues should be consistent. So what does that mean? It means don't overspend. Okay. What does it also mean? And nobody likes hearing this. I didn't like hearing it. Don't like doing it necessarily now. It's like a necessary evil. But you got to do a budget. You got to know, what's my budget? What is my budget for payroll? What is my budget for marketing? What is my budget for supplies? So you don't want, if you're trying to get an investment for a future project, no investor, and I'm kind of working with banks here, but also it could be a private investor as well, credit union, so forth. They don't want to look to see like a whole list of expenses and they don't match the revenue or the income that's coming in. But you have all these expenses and they're just not matching up. So while everyone says, oh, you can write off this, you can write off that, you need to be very careful with that to make sure that what you're actually spending on the business matches what you're bringing in. Otherwise, it looks very, it looks like there's too big of a risk on that. So expenditures should match your budget. And the nice thing, that the best thing you can do is say, hey, here's my budget, especially if you're trying to get capital investments. I'd say do it now. Like, we're in January, beginning of the year, and now's a great time to really put this in place. So maybe 6 months from now in the summer, you can then approach a financial institution to say, hey, here's my 2023 budget. Here's the one I had from last year, 2022. Here's all my expenditures. They not only match what my budget expectations were, they're under. So tighten the belt a little bit so that way you can get some longevity down the road. And then investors like to see that working capital is being used wisely and intelligently for managed growth. And that goes back into your bookkeeping, your accounting, keeping track of the invoices, keeping track of your expenses. So knowing what your revenue is coming in, what the income in, gross income is, and then knowing what your final revenue and profit is. Any questions so far? So working capital versus capital investment, two different things. One is running your business, one is asking for funding for future business. All right. So we talked about a business plan, and a lot of people skip this step. I know I was close to skipping that step too, but I can't emphasize how important it is to do one. It's great to start with an idea. That idea has to translate into paper, and then it grows from there. So you're not changing your whole business plan every year, or maybe you are, depending on what you're doing. But you have to have a prepared, well thought out business plan where you are going. It's a roadmap. So you can't drive on the road unless you have the roadmap. It's kind of like today's version of Waze, or the Google Maps. You got to know where you're going with it and what is on the way. Are there stops? Are there licenses you need? Is there regulatory stuff? So in every business plan, you're going to have an executive summary, the body of your plan, and then a conclusion, what your business is going to do. So that's just the bare bones. And if you haven't done one, don't beat yourself up over it. It's never too late to start doing one. So, and now's a great time. We're at the beginning of 2023. Sit down, think about what's your business plan, what's your summary, your executive summary, what is it that you're doing? Then the body, you're breaking it down into an outline of the different steps. Maybe it's the different departments that you have, maybe it's the different people you have in your department. And then what's your conclusion? Where are you going? We're going to provide the best service at the best cost. We're going to provide certain widgets to people that we're going to sell. We're going to do wholesale, retail, whatever it is. So investors want to know your marketing strategy. So that goes right into it. What is your marketing strategy that's going to deliver these revenues? In real estate, they talk about your sphere of influence. So that's reaching out to the people within your sphere for your business. That might be one marketing strategy. You're reaching out to all the people that you know to either invest in your business or to give them information about it. You might have a more robust marketing strategy where you are going to be posting on Facebook, Instagram, Twitter, whatever the marketing strategy is. It has to be something designed that's going to bring you business. And investors want to know what that strategy is. And that should be in your business plan. Like, include an actual section for that. And you can start really lean and mean. Posting things is an easy way of doing it if that is going to generate business. It could be just getting the word out to friends and family, people in your sphere, but have a set plan. And then that plan is also going to vary as you move forward. If it's in your January business plan, maybe you review it, say in June, mid-year, and you add on to it or you take stuff away. Three, have accurate financial data of the company for the last 5 years. So most financial institutions do want to see 5 years. Have we all been in business for 5 years? You may not have been. So that's okay. They would like to see 5 years. At some point, you will be in that 5-year mark. So if you set everything up now, it'll take you to the next level when you're providing all this for your next capital investment. But you got to start somewhere. So if it's less than 5 years, then you want to run reasonable models using that use pro forma industry data. What does that mean? Pro forma industry data just means you want to be able to run a model that looks like your competitors, that shows your investor why you're going to be successful in this. So pro forma is just another way of saying this is generally what's used in my industry. So for projects. So for example, with my business as a law firm, you can run a pro forma to say, look, I have 2 paralegals, I have associates. This is what I expect. This is what we had last year, the year before. Now we've been doing it for a while. So you have a growth model. So this year went up, this year went down, it went up again. So you can do that. So if it's less than 5 years, run a reasonable model, what it's going to look like. Not only does that help your investor, but it also helps you too. So that way you can have reasonable expectations. And this is based on the market, the economy, and all other factors that might come in. So a business plan is generally required by a financial investor. So don't skip it. I know even with the BDC here for some of these not for some, for all of them, you have to show your business plan. I don't want to have this conversation 3 years from now and you're using the same business plan. Okay. So that's a really great start. So have that plan. It's excellent to have it, but review it and then add on to it. So in addition to your business plan, you're going to have to provide personal financial data and assets from business owners. So anyone who owns the business, those are generally going to be required. So make sure your taxes are done. Lenders are looking for 2 years back. Your 2 years income taxes. They might look at paycheck stubs. In addition to your bank checking and saving account, they might be looking at your individual personal ones. So be very cognizant of keeping track of that and having it accessible. Collateral, if you're getting a bigger loan, sometimes banks will want you to collateralize something, which just means that you're putting a little more skin in the game. So you might have property and you're going to say, well, if you lend me $300,000, I will also be able to, you can put a second lien on this property that I own. Okay. Be very careful with that because banks do collect on that. And I've represented clients that have cross collateralized different buildings and, one may have gone south and now the bank is trying to collect from the other one. So be very careful of that. And then banks will want you to do a personal guarantee. So if the business hasn't been up and running for at least 2 years, they'll want you to personally guarantee that. And that's to avoid, setting up an LLC, opening up a business, getting a loan, and then filing bankruptcy. So banks will have kind of a backdrop for that where you personally are guaranteeing on that loan that it's going to be paid, even if the business isn't able to.
Libby, if I can add something about
Absolutely.
the business plan. I know that seems like a kind of an intimidating process. It's lengthy. You have to explain a lot. And as Libby mentioned, that document is what's going to be required to really help you get anywhere with your business if you're looking for any type of access to capital financing. So there are resources out there. As I mentioned, part of the Cook County Small Business Sources Business Advising, the Women's Business Development Center is particularly known to specialize in helping businesses write business plans or update your business plan if you have one. We also have templates of one that we could share. So if anyone has questions about where to get started with a business plan, there's plenty of resources out there. We are happy to share or get you a referral over to the WBDC.
Yeah, that's an excellent point, especially if you haven't done one, or if you need to revise it, get the template because it'll just walk you through some of these things. So like Paula said, it can be very intimidating. But once you get past that, it's not hard. This is the business that you're investing in, and it's what you're doing. So a lot of this intrinsically, you just need to put it down on paper. And the BDC offers excellent resources for that. So definitely use that to come in, or even have someone take a look at it. Send it over. I'm happy to take a look at it and say, hey, you need to fill this in, fill that out. So next thing is strategic positioning and planning. So we talked about everything you need for your capital investments. Now we're talking about positioning yourself and planning. You already have the business, it's up and running. you're moving towards growing. You want to think about some of the other things that come into play with your business plan. So use your brand, use brand positioning to promote your product or service. Make sure you have a website, and you guys also help with the websites, don't you? The BDC will help, get you started. I don't remember which.
We have the internship program with Morton College that's for businesses in
helping.
Berwyn, chamber members. So some of you on the call may not be local. Some of the programs that we do offer here at the BDC are tailored to businesses in Berwyn or in the area. But like the BDC, there's other organizations out there. So if you don't know where to get started, if maybe we can't help you directly, a good, again, point would just be referring you to your local development center or the nearest business support organization that could maybe help with some of that.
Yes, and most local chambers will have something that'll help you get this set up. So get a website, set up your social media marketing and other marketing. If you are going to have ads, TV, radio, magazine, that should be in your business plan, and it should have $1 assigned to it because that's part of your budget. So you got your plan and you got your budget. Okay, hopefully the two mesh. Sometimes they don't. You need to revise them, but you can definitely do that. So plan on that. Publicize your new approach. If you have a new approach to your business, you're implementing this for this year. You have new employees, you have new associates. Go ahead and let people know. Social media is an easy way of doing that. And make sure you put that in your plan. Do brand positioning presentations. So if you're going to other places to present, do workshops, so forth, you want to make sure that your brand is out there, your new brand, or maybe it's just tweaking the old one. Maybe it's just getting the word out. Think about retaining current customers and then also attracting new ones. So don't discount the current customers that you have when you do your business plan. And this is why it needs to be reviewed at least every year. You want to look at the current customers that you've had and what you need to do in your industry to keep them. Then the second part of that is attracting new ones. And it's really easy to kind of fall into, hey, I just want new, I want more customers, but don't discount the current ones. And then understand your customers' needs and requirements, and those change with the economy, with time, with the year. If you're in a seasonal business, it might be changing. So think about that. And then we talk about like deploying a stealth brand launch. So that's the more subtle one. You're not making some grand, splash of your new brand, but you're getting it out there. Maybe you just kind of start putting the word out there and then doing it on a consistent basis. That should be part of your plan as well. Like, when are you going to do it? We're going to get 3 things out this month. We're going to get 4 things out next month. We're going to have an event. So doing more of a stealth brand launch so that by May, everybody knows your new brand or everybody knows your current brand. Okay. So that's strategic positioning.
Libby, I just want to do a time check. We have 5 minutes left. So
we're just about done.
Perfect.
So business expansion framework, make sure you remember your legal requirements. Depending on your business, you've got your licenses. Do you need to incorporate? Do you need permits? Operational, this is your staff, your vendors, your supply, your internal plant. That's your working stuff. And then financial, doing your operating budget, your marketing budget, ROI, rate of investment. So that's more of the capital investment part. So this just kind of brings everything we've talked about into one place, which is your business expansion framework. And it does adjust over the years. Oh, that was my last slide. So any questions from anyone? If you guys don't think of any questions now, or you don't want to ask them now, feel free to contact me. My email is below. You can also text me or just call the office. I'm happy to kind of walk you through anything we talked about today. Any questions from you guys?
Really information.
Yeah, there's a lot of good information here, Libby. And I know Libby, before she came in and presented, she was asking for me to maybe share a little bit more about the resources that we offer here at the Berwyn Development Corporation. So I can quickly run through that. As I mentioned, some of the programs that we offer are specifically tailored to businesses located in Berwyn, but that doesn't mean that you can't maybe find that locally with your chamber or with your local development center. So just as an example, some of the programs we offer are renovation grants to businesses who are moving into an eligible TIF district. So that would be a corridor here that has been designated an area that needs improvement, renovations. So the goal is to increase the economy there. So we offer programs where we reimburse business owners or property owners of commercial properties up to half of the investment that they make on interior or exterior build out. So that could be a new signage for your storefront, If you need to do brickwork, some tuck pointing, new flooring, a lot of things that kind of fall under that is something that we offer here. And then also we do have small business lending options. So that would be for maybe somebody who hasn't been established for more than 2 years. I know, Libby, you said that traditional banks are typically looking for at least, well, 5 years ideally, right?
Yeah,
But
5 years ideally, 2 years, but you know,
yeah,
it depends on your relationship with the bank too. And this is also where chambers come in and your local municipality for some of these grants. Look at them because they will have different requirements, but for all, you're going to need a business plan and you're going to need to show that business plan of, you know, kind of where you've been and where you're going.
yeah, and there's a lot of the businesses that we've had communications with, they've been rejected at traditional banking because they don't have 2 years. Is what we're
Right.
seeing. 2 years is typically, you know, the
That's kind of the
expectation.
benchmark, yeah.
Right. So there's organizations like here at the BDC, we would offer or maybe consider a startup business who needs funding for one of our micro loan programs or commercial loan programs. There's a lot of programs out there. But all you have to do is get in touch with the right people, get connected to the resources and ask the questions, because there's more than likely something out there for you. It's
Yeah,
just
absolutely.
making the time to connect and,
Right.
and do some research. So I would certainly encourage you all, if we don't have any questions, like Libby said, anything that you can think of maybe at the moment, we will be sharing the slide deck along with the recording of this presentation towards the end of this week. We do have another presentation this week, so we want to make sure we get them both over to you. If you do have any questions, please raise your hand now, drop them in the chat. Otherwise, we will be sharing Libby's team's information so that she can connect with you. And I just want to say again, thank you, Libby, for being here with us
Welcome. Thank
today
you.
and for giving us this very, very resourceful information.
No, thank you for having me.
It looks
Sharon
like
raised her
yep,
hand.
we do have a hand. Sharon.
Oh, hi, I'm Sharon Armstrong and I'm in Glenview. And I have a
Sharon.
question because I have a service business. I'm a massage therapist.
Okay.
And I'm about to venture on a speaking platform so that I can teach.
Oh, that's great.
So,
Okay.
so moving from, practicing into teaching.
Mhm.
Is that considered a capital move?
It can be. It kind of depends. Are you affiliated with like a school, like you're going to be teaching at, like a massage school, or you're going to be doing workshops, or as part of like, a different coaching plan? That
Yeah.
could be part of it because you may be doing travel. You might need certain equipment to go with it. And that's
Mhm.
something you should include in your business plan for this year. What do you
Oh.
anticipate for the first quarter? How many are you going to do this year? I'm just making up numbers. Maybe you're going to do 3 or 4 this year with the plan to do, 7 or 8 next year. So that is, that can be considered part of capital investment, depending on what you need.
Okay, great. Great, thank you.
Absolutely. You're welcome.
Have another raised hand.
Sure.
Fatima?
Fatima?
I'm sorry. Hi,
Hi, how are you?
I'm good. How are you? My question is, I have I have a property, but it's in my business. It's in my personal name.
Mhm.
Is it better to just leave it in my name or transfer it into my business name? Because it's a rental
Mhm.
property, but it's
Okay.
not in my business name. And
That's a
it-
great question, and it's one that I actually get a lot. So it's really going to depend on, is there a mortgage on it? So if you have a mortgage and you got that mortgage and you're the only borrower, the only mortgagor on it, you're not going to be able to simply transfer it into the business name because there's a mortgage attached to it. However, if it is fully paid off, it's an investment property, you can bring that into your business and that'll be a business asset under your business name. With this caveat, I don't necessarily recommend it. So any properties that are owned, you might want to consider opening up a separate LLC and owning that as it's a separate entity that owns it for liability reasons. So
And-
a lot of my clients will do that.
And the company that I have, it's not an LLC. It's just I didn't do an LLC for the property company that I owned.
It could be a
So
sole
what's the difference
proprietorship.
between, okay, because it's just incorporated. That's it.
Correct. Yeah. Sole proprietorship is you own it. An LLC gives you a little bit more protection because it's a limited liability company. So it's not owned in your name, it's owned in the company's name.
Okay,
Yeah, so it'll depend on whether you have the mortgage on that or not. So you'd have to check in with your lender to see what you're able to do.
okay, okay.
Right. Those are some great questions. A
Yeah,
lot
those are
of
great.
very, very resourceful information. Thank you so much, Libby.
You're welcome.
Again, we will share the slide deck and the recording. We will share Libby's contact information if you want to set up a consultation with her and her team. And yeah, that will be all. Thank you so much,
Yeah,
everyone, for
thank
joining
you.
us. Thank you, Libby, and have a
Thank
great
you.
rest of your
Have a
days.
great Tuesday.
Thank you.
Thank you. Have a good one.
Bye-bye.
Bye-bye.
Good one.
Bye.